Our next speaker heads up the blockchain and fintech practice at New York-based law firm Murphy and McGonigle. So please welcome to the stage Matt Comstock.
Thank you. Everybody hear me okay? Great. Yes, Matt Comstock. I'm with the U.S. law firm Murphy and McGonigle. Just very, very briefly, a little bit of my background. I used to be an attorney for the U.S. Securities and Exchange Commission, which is the primary securities regulator in the United States. I'm now an attorney in private practice, and I represent startup companies and brokerage firms and trading platforms, among other things. And let me just, as an initial matter, apologize for my deck. You've seen a bunch of very good decks. This is what happens when you let a lawyer make a PowerPoint presentation that looks like this. But hopefully it'll be at least a little bit helpful in following along. So I'm going to focus on securities regulation in the United States and you know, the impact mostly on digital securities, or what I refer to as digital securities. You know, as all of you in the crowd know better than I know, blockchain technology is being adapted across a number of different industries at a very high rate, and it's being done on a global basis. And you know, among many types of companies, including a lot of startup companies. So those startup companies need capital, right? And the capital markets are global in nature. You might have an Israeli company that is raising capital in Malta or the BVI or elsewhere. So it matters very much, though, from whom you're raising capital and where you're raising that capital. So I'm going to talk a little bit about that. So blockchain startup companies in 2017 raised about $5.6 billion US through ICOs, through initial coin offerings. In the first quarter of 2018, that number was about $6.3 billion. So in the first quarter alone of 2018, the total raised in ICOs was more than all of 2017. The interesting thing from my perspective is that very, very little of that activity actually occurred in the United States. So let's talk a little bit about why that is. So the first question is, can a company even conduct an ICO in the United States? And I'll give you the lawyer answer, which is, it depends. And it depends on what you mean by ICO. So I put up what sort of how I view an ICO in the PowerPoint here, and that's, there's a publication of a white paper. You know, sometime after that, there's an issuance of a token. There's payment for that token. Typically, payment is in the form of some sort of cryptocurrency. It could be fiat currency. And then the company uses the ICO proceeds to build out the platform, whatever its platform is. And often there's the issuers allowing the investors some sort of share in the economics of the company. And there may be some exchange trading of the token. And it's those latter 2 points that cause problems under the U.S. securities laws. So the SEC, the United States Securities and Exchange Commission, has taken the position that what I'm referring to as the typical ICO, what I just put up on the previous slide there, involves the issuance of a security. So last year, in July of 2017, the SEC issued this report that they called the Dowell Report. And the SEC was concerned about all of these ICOs that had been going on in the United States. Now, they may have started elsewhere. They may have been with companies that you know, were outside of the United States. In this particular case, the Dowell organization really started in Germany. And the SEC looked at what they did. They said, hey, you're issuing these tokens. You're using these tokens to raise capital, and then you're using those tokens to build out your platform. And importantly, you're doing 2 other things. When you issue the tokens, you're giving the token holders the ability to actually earn something on the projects for which you're using their capital, the capital that they've given you. And on top of that, you are you're offering exchange trading of these tokens. So the SEC looked at they took those facts and they said, you know what? This is new technology. These are new approaches, but we have securities laws that have been around for about 80 years, and we have this thing called the Howey test. And we asked 4 simple questions. Was there an investment of cash? Was it in a common enterprise? Was there an expectation of profit? And is that expectation of profit based on the entrepreneurial efforts of others? And they said, you know what? In the Dow, that's what it looks like happened to us. But the SEC sort of exercised a lot of restraint for the SEC anyway, and said, you know what? We're just going to put out this report, and we're going to fire a warning shot. It says, if you're going to raise capital, and you want to use an ICO, remember this test, because the next time, we're probably going to come knocking on your door and bring an enforcement action against you. So that and speeches from the SEC staff and another case called Munchie sort of chilled the ICO market in the United States. So what does that mean? That means that if you're going to capital raise in the United States for your startup company, you need to comply with the federal securities laws. First and foremost, you need to comply with what's called the Securities Act of 1933. And what that act basically says is, look, you can raise capital in the United States. You can do it more or less now in one of 3 ways. You can do what's called a private placement, which means you have to sell to, this is where the type of investor is very important. You can raise capital. You don't have to come to us, the SEC, and register your offering. But what you do need to do is make sure you only sell to accredited investors. And those are folks who basically are wealthy, relatively wealthy. They have to make at least $200,000 a year, have $1 million in assets. Or you can do something called a Reg A offering, where you can sell to the general public, but you're capped at $50 million, and you have to jump through some additional legal hoops. You actually have to talk to the SEC, and it's a little bit more of a regulatory lift. It costs some money. You're going to spend money on lawyers. Or you can do a registered public offering, which is the most expensive way to go, but that's where it's a high touch with the SEC. You have underwriters, that sort of thing. So that's capital raising in the U.S. Let's talk just briefly about capital raising outside of the U.S. Most ICOs today, what people would consider to be an ICO, are being conducted outside of the U.S. And they're being conducted outside of the U.S. by both U.S. companies and non-U.S. companies. But what we're seeing happen more and more is that the sophisticated issuers are actually conducting their ICOs in a manner that complies with what's called Reg S. And what it is really is just a means to allow somebody who is capital raising outside the U.S. to avoid the long arm of U.S. law, because the regulators in the United States will try to assert their jurisdiction wherever they think they can assert their jurisdiction. And basically what it is it's a safe harbor for these offerings outside of the U.S. If you don't try to use U.S. jurisdictional means, meaning if you're not advertising your offering to folks outside of the United States, you're taking some sort of reasonable steps, like setting up a website that says, if you want to raise capital, if you want to participate in this offering, you can't be a U.S. Resident, that sort of thing. So that's what we're seeing outside of the U.S. What we're also seeing is investors who are raising capital outside of the U.S. but doing something like a private placement in the U.S. that's compliant with federal securities laws. So, interesting issue though that arises if you have an issuer who's raising capital outside of the U.S. A lot of issuers are issuing tokens, right, as part of their ICOs, and in a number of cases, what these companies would do is they would issue their token, maybe it's an ERC20-based token, for capital raising purposes, and then they wanted to turn around after they did their capital raising, build out their platform, use that same token for consumptive purposes, right? They're going to use that token in the United States. They're going to sell it to persons who are actually interested in using their platform and using that token. The problem that they're running into, though, is that token was issued outside of the United States in a way that made it a security. So now they want to use that token or sell that token to persons in the United States to use on their platform. And the way that most practitioners viewed that token is they said, you know what, you have this token that you want to call a utility token, or it has consumptive use, but it's a security, and now you're trying to sell it in the U.S. So that continues to be a problem that non-U.S. issuers are running into, or persons issuing outside of the U.S. But we've seen a little bit of thawing just in the last couple of weeks, right? This is sort of the dynamic nature of this area. The SEC is still trying to catch up. Other regulators are still trying to catch up. There was a guy who did a speech, William Hinman, a couple of weeks ago, and he is the director of the Division of Corporation Finance. They're the folks who deal with registration issues and whether something's a security and capital raising matters. And he gave a speech that basically said, look, something that starts out as a token or something that starts out as a security under certain circumstances may be able to convert into something that is not a security. So these folks who are issuing securities outside of the United States, then turning around and using that tokenized security, may actually have some hope. But as with all things with regulators, it's difficult to sort of fully understand what the parameters of that thinking is right now. So that's yet to be determined. I think that gives us some hope. Okay, so that brings me to sort of the final issue, which is, all right, I have an issue, or I have a company that wants to raise capital in the U.S. How do they do it? Now, as I said, they issue securities in a manner that's compliant with the securities laws. So what we're seeing now is startup companies want to issue securities in compliance with the federal securities laws, but they want to do it on the blockchain, right? They're blockchain-based companies. They want to issue a security that's in what I'll call tokenized form, or what we also call digital securities. So that then raises questions. All right, how do you do it? Right? You issue security on a blockchain. It's a private placement, right? You sell to these, what they're called, the accredited investors. Those securities are restricted then for some period because they're issued in a private placement, and you can't just trade them like you could a security issued in a public offering. Or they'll issue securities that are freely tradable because they're registered or issued under Regulation A. So what issuers and trading platforms are doing are figuring out ways to trade these securities. So these securities issued on the blockchain have to trade on some sort of platform in the US, right? They're going to trade on what's called a typical exchange. Think about New York Stock Exchange, NASDAQ, one of those. Or they can trade on something called an alternative trading system, which is basically a brokerage, a glorified brokerage firm. But those entities would be registered with the Securities and Exchange Commission. They would be registered entities. So what would happen is the issuer issues securities on the blockchain. They exist on the blockchain. They would trade in digital form, and they would trade on these platforms. They can trade just like any other security, but there are certain difficulties or certain things that need to be worked out with trading digital securities. The most significant issue is how do you custody them, right? So this is not custody necessarily it's sort of in the same in the same concept as custodying Bitcoin. The issue of custody for securities is that there are rules around how securities have to be custodied. Historically, in the United States, if somebody owned a security, it was either in paper form, so the brokerage firm held a piece of paper in a vault at the brokerage firm, or they existed in book entry form, similar to digital, but not exactly the same thing. So securities issued in sort of in book entry form were all held at this entity called the Depository Trust Company. And the Depository Trust Company is basically the owner of almost every equity that's ever been issued in the United States. They are the legal owner. And then anybody else who's holding those securities holds them through brokerage firms, and the Depository Trust Company just shows on its books and records that these brokerage firms own all these securities. I'm running out of time. So the bottom line is, though, that right now the startup companies, trading platforms are working very closely with the SEC to figure out how digital securities can be held in a way that is consistent with them being on the blockchain and makes sense from a U.S. regulatory perspective. And with that, my time is up. Thank you.